Hey, Ray, what's going on? Is James here, and I wanted to sit down this evening slash this morning. It's a little after midnight. I want to sit down and shoot a video because somebody posted a chart up in Discord that sent me down a rabbit hole that I don't go down a whole lot anymore. Looking at macro pictures and macro time frames and things like that, I stopped worrying about all that stuff because it doesn't really have a lot of impact on today. And I just didn't really see the point in stressing out about things that might not come to, pass for 6 months or 6 years or 15 years or whatever. But I did take a look and it was interesting. And I definitely think it's, noteworthy to kind of look at what's happening. And I'm going to put this in perspective and try to keep the video on point. So there's two sides to what I'm looking at. The first side is obviously the technical analysis side. And for those of you that have followed me for a long time, you will remember that I actually used the NDX chart to help predict a future Bitcoin cycle. So back in 2019, I was watching this and I was looking for a dump, that $3,500 to $4,500 call that I made. Part of it was based on this idea that I felt like we were following the NASDAQ's .com bubble and that we had a disbelief phase coming that we would dump. And that is literally exactly what happened. We dumped right below the 200 moving average here. And one of the things that I had hypothesized was that because Bitcoin traded roughly 4 times as much as the NASDAQ, meaning as many open hours, that we could use a weekly chart and kind of put it side by side with a monthly chart on the NASDAQ. And so this was a weekly chart with a 200-week moving average, and this was a monthly chart with a 200-month moving average. And I used that chart to kind of predict Bitcoin's movements. But now I almost wonder if we could use Bitcoin's movements as a predictor for what the NASDAQ is doing. So if I look at these side by side, and I'm not an Elliott wave trader, so I'm just using these numbers, but really I'm just using it to illustrate general movements in the market, not specific Elliott wave rules, okay? So we look at this as a 1 to 1. And of course, we look at this as a 2, which would be our disbelief dump, 2 to 2, and then 3 being this initial pump here. These are both log charts, by the way. So there's our 3. And if we look at the pullback here, this was about a 35 to 40% pullback. So if we look at that as our 4, we had about a 50% or 55% pullback on Bitcoin back in 2021. And then it had its final, gasp of life before the market rolled over and fell 75% below its 200 moving average. And so it's possible from a technical analysis standpoint that right now we are moving toward 5, right? Toward this 5 level. It's never going to be exact, or very rarely going to be exact, but that was a roughly 139.5% pump from its pullback. Right now, the NASDAQ is up about 127%. So 139% would put it up around 25,000 points. That's also kind of like a psychological level almost, like 25,000, like 25 cents, right? A quarter of a dollar, a quarter of 100,000. So there's some psychological power to that. And if I look at that and I was just looking at it in a vacuum, it would still catch my interest because of the way that my brain works with patterns. I would be very interested in that. And there's some differences here. Let's we're pointing out some similarities, but let's also notice that this was more of a double top type of pattern, whereas this is obviously a clear higher high. So it's not exactly the same by any stretch. All right. But it's very similar in other ways. Like, for example, this came down and retested this liquidity and then had a bounce. And that's what happened here as well. It retested liquidity and then bounced. Okay. So some similarities, some differences. But I laid out a thread inside of Discord and in my public Facebook group explaining some of the fundamentals behind why I have some macro concerns as well. And I want to be super clear about this because a few years ago, especially, I almost rooted for some type of mass sell-off because I was really excited about the possibility of buying super cheap stock and super cheap cryptocurrency and things like that. And I was looking at, this could be a generational wealth opportunity. I always like to try to tell people where I'm at emotionally. I emotionally am getting older. I'm approaching my mid 40s now. And I'm not rooting for a major sell-off, because if it came to pass in the next year or even the next 5 years, that would put me closer to 50, and it might be a 20 or 30-year recovery period, which would put me in my 70s or even possibly my 80s. That doesn't really fit in with what I need to happen for my best interest. If I was, 25, it would be super exciting because, I would have all of my working life to essentially invest in an undervalued stock market. But at this point in my life, with my age and everything, it would not be exciting because I just don't have the time on my side the way younger people do. So I'm not rooting for this, even though I think it's a very real possibility. Unfortunately, I don't really like any of the scenarios I see in front of me, because that's one scenario. The other scenario is things just stay overheated for even longer and the can gets kicked down the road. So I kind of view this as a whole lot of bad options right now. I also don't want to be 55 or 65 when the market finally decides to revert to its mean. But let's look at this particular scenario. This is the technical side of it. Let's look at the fundamental side of it. All right, so I'm just going to share, the inside of my Discord here. So this was the post that I made. I made it just a few minutes before doing the video. I used GPT to kind of summarize my thoughts and put it in a much more friendly one-page format. So this was GPT formatting, but my thesis. So it says, AI, the modern mechanization, a roadmap to Great Depression 2.0. Stage 1, the hype cycle. So in the 1920s, we had mechanization, which promised endless productivity growth. Essentially, a lot of jobs that used to be done by hand, machines started replacing those jobs, making production skyrocket. Took less people to get the same amount of work done. We are seeing exactly the same thing with AI, and a lot more industries than most people realize. So a lot of people automatically think about things like coding or perhaps the arts, but it's not just coding and it's not just the arts. As an example, my daughter's boyfriend, who she's been dating for a few years, is in his last year of college. He's going to be a radiology tech. They're essentially the people that, take you down for the CAT scans and MRIs and all that sort of things. And what we found out, I started talking to some people in that line of work because I was, interested in it and interested in, what his future looked like. And I found out that already they're losing jobs in that sector, which is not one you'd even think of. The guy that worked at the local hospital told me that essentially he can do the job of 10 people now because AI does a lot of the job for him. And so he was telling me how it's already reducing, the workforce. We're going to see that in a lot of industries. For example, anything that's knowledge-based is especially easy game for AI, but it's also going to be in some other industries. And eventually, long-term, I think it'll be in industries that people may not even be considering today. So for example, some of you know that I own a dirt company, an excavation company that I started about 3 years ago. I was essentially an investor in it. I don't actually do the work itself normally, but I invested in it. I'm a 50% owner. And you would think, well, that's an AI resistant industry. I don't think it is. I think long term, what we will see is AI will be built into the equipment itself. And some of the things that operators do right now, AI will do, that's longer down the road. But I definitely see a future where a lot of jobs are AI. So just something to think about. That's the promise, though, right? We're going to, be ultra productive. So in both areas, we had capital flooding into the leaders and valuations detached from reality. We've already seen that. Everybody, for the most part, agrees that we're in some type of AI bubble. 2, the short-term success. So productivity surges, companies cut costs and payrolls. We're already seeing this. A member of my Discord, for example, has been working in the arts for over a decade and was laid off this year, right, from a major game studio. And that's directly linked to AI, replacing jobs and allowing one artist to do the job with several artists. Same thing with coding. A lot of junior developers, those jobs are being eliminated. Even mid-level developers, jobs being eliminated. You don't need 20 developers when one developer can do the work of 20. Next up, hidden costs. Mechanization displaced millions of workers, especially in the agriculture and manufacturing sectors. AI is already threatening a wide range of knowledge and service-based jobs. And I can tell you that it's also going to threaten manufacturing jobs in the future as well. Displaced workers struggle to retrain fast enough, which increases the unemployment rate. Number 4, the economic feedback loop. Fewer jobs means lower household income. Lower income equals reduced consumer spending. Weaker demand equals earnings decline outside of the AI leaders. Market lost breadth. Concentration unwinds. Asset prices fall. Wealth effect reverses. Credit tightens. Layoffs accelerate. For those of you that don't understand this, when credit is expensive, the cost of doing business is more expensive, and that's one of the reasons that companies shrink workforces. Number 5, the collapse. In 1929, mechanization plus speculative excess equaled a stock market crash, which led to the Great Depression. And a possible 2020s repeat, we already see, the AI booming, right? We see stocks that are worth many, many times what they should be worth. Could lead to a liquidity crunch and a demand collapse, leading to a multi-year deflationary spiral. Now, the irony here is a lot of people want their cake and want to eat it too. A lot of people are complaining about high prices and about inflation, and they want prices to go down, but they don't know what they're actually asking for. The only way prices can go down is through deflation. And typically the only way to get deflation is through massive economic pain. For example, during the Great Depression, we actually saw deflation where the value of a dollar increased. I don't mean like versus other currency. I mean the purchasing power of a dollar actually went up during the Great Depression. A little known fact, people who were cash rich during the Depression actually lived like kings. So I suspect that some people are going to get their wish. They're just going to learn the hard way. Be careful what you wish for, because deflation happens through economic collapse. Winners survive, but at far lower valuations, and everyone else suffers deep losses. And by the way, I think this will absolutely cross over into cryptocurrency. If we have a massive crash in the stock market, I definitely believe that we will see a 95 to 99% crash in cryptocurrency total market cap. Number 6, the warning signs today. The market concentrations right now are at 100-year highs. Valuations priced for AI perfection. Essentially, people are already pricing in all of these amazing things that AI is going to do, and it may do it and it may not. But unfortunately, if you've already priced it in, if it does it, you're just living up to expectation. If it doesn't, then you light the powder keg. Passive flows mechanically inflating mega caps. Early signs of tech sector layoffs. We're seeing this, plus wage stagnation. Bottom line, AI could absolutely deliver on its promise of higher productivity, but just like mechanization, it could hollow out the middle class in the process. This is something that I've been worried about now for a couple of years. It's a really big concern that I have. If the wealth effect dies, so does the market bid. That's how you get a Great Depression 2.0. Not because the tech failed, but because it worked, and it worked too well, too fast. The thing that people forget is markets are auctions. And in order for a price to go up or even stay elevated, there has to be buying demand. When buying demand dries up, price goes down. If all or most of the buying demand dries up, price goes down drastically, and we get liquidity crunches, and we get massive gaps. And we saw this during COVID. Liquidity completely dried up and the market completely fell apart. Bitcoin specifically fell all the way down to numbers that most people up to that point, not me, but most people said were impossible to ever revisit. And I think we will see a repeat of that in the future, unfortunately. And I don't share this video as a doomsday scenario, like, hey, run out right now and make plans. I don't know when this happens. I don't know if it's going to happen in the next month or the next 6 months. I don't know if it's going to happen in 5 years or 10 years. So this is in no way a video that's saying you should make certain actions in the market today. It is simply a video saying you should be aware that this is a very real scenario that could come to pass, it's important to do your due diligence and set yourself up in a way that if it were to happen, not only could you survive, but potentially thrive during such a scenario. So these are some things that I'm considering. Again, I have very real concerns about this. I am not rooting for a Great Depression or a major market crash because of my age and where I'm at financially speaking. I'm kind of in the backside of my financial journey where I'm pretty comfortable. I'm not really in growth mode anymore. Now I'm pretty much in the mode of, hey, don't do anything stupid and you're good for the rest of your life kind of mode. So for me, major market crashes are far less exciting than they used to be when I was still in my 30s. All that being said, please remember that I'm some guy sitting in a spare bedroom, and that means that nothing in the video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. If you enjoyed the video, be sure to give it a thumbs up, subscribe to the channel, and please consider sharing with your friends. Again, I've mentioned this in past videos. It does seem like I've been shadow banned. Even when I tell people about the channels, they can't find the channel when they try to Google it. And so I would definitely appreciate it if you can share the link to the video with any friends or groups that would appreciate the content. Please don't spam people. That's not cool. But if you think you have friends or groups that you're part of that would appreciate a different viewpoint, I would certainly appreciate you sharing the content with those folks and help getting the word out. All right, this is James with Crypto Common Sense, reminding everyone to please trade safe, and I'll see you in the next video.